All right, everyone. First episode on the channel. Why not start in the best place in Australia, Manly Beach? This is my personal favourite. Going to talk about both houses and units in this market because they're pretty even within this market of what it has to offer for houses and units. Typical price for houses is 3.8 million. Typical price for units 2.15 million. Yields are typically trading at around that 2.5%. One of the biggest things to note for this market is when you're looking at, high level supply and demand of dwellings and population, there's only 1.6 times the population compared to dwellings. You're typically seeing, in a lot of highly dominant owner-occupied markets, you're sort of trading at around 2.5. So very different for this market. In terms of price growth and sales volumes, you can see this is a graph of houses with sales volume and price trends. It's quite volatile, this market, but a lot of people see Manly Beach as this really desirable area and blue chip real estate, and that it's the best place to invest. Not, of course, relative to all of the other blue chip locations, but it is a very affluent and highly desirable area. But it only did 43% growth over the past 10 years. So it's quite inferior to growth that for a lot of markets across Australia. And, the volatility, as you can see, it's highly volatile. And the fact that 43% over 10 years is probably reflective of the fact that it hasn't had much growth, if not any, for the last sort of 4 years. So it's probably why that figure is so low. Once it starts to accelerate, obviously that figure is going to change, but it's not going to be anything significant relative to the amount of money you can make in a lot of other markets. When we compare it to units in this market, 10-year price growth is 64%, but as you can see, it's a lot less volatile. So, from an investment perspective, when you've sort of got typical yields trading at the same price point, especially liquidity is a big risk factor for buying property. You want that consistency within a market. There are standouts, of course. This is just the average for the overall market. I mean, I've seen a property trade in Manly for, I think it was like a $7 million profit over a 7 to 8 year period. So definitely outliers, but this is just the market overall. When we're looking at rent increases have sort of increased by 31% for units. I think roughly 40% for houses in this market is nothing significant, but they are really consistent with the increase in price. So, it's not highly volatile like the sales market. You can see here growth cycles for houses and units are both very similar, slightly longer periods of growth for the unit market. But as you can see, there's massive ebbs and flow within this market. There's no real flatline consistency. But the good thing is when you're going through those significant periods of growth, you're seeing upwards of 20%. And I mean, this is the sort of abnormal period for most of Australia, but around that COVID-19 timeframe, they got 26%. So, when you are getting such significant growth within these markets, it sort of complements once you have a contraction of only 5%. It sort of balances out. But like I said, with that sort of flat line or plateau within this market for houses, you can see that within the growth pattern deviation and the spillover potential for this market. It is quite a good position for this particular market at the moment to be buying, because you've got, I would say, and we're going to get to affordability at the moment, but I'd say affordability is suppressed, and we're going to enter into another cycle as we can start to see here that it's going to start to recover and likely enter one of these growth cycles again. Typically, I would not like to see this in a market. However, it's really property specific, and that's why you need to sort of analyze each property individually and not just look at a high level market. But renter to owners and units to houses, it's quite saturated with units and saturated with tenants. So when you're looking at that, just say that you go and buy a 2-bedroom unit, which is majority of the Manly market. If you're buying a 2-bedroom unit and you're leasing it, well, you're leasing it with 50% of the other market likely. So what property are you buying that's going to stand out in this market and make those tenants want to lease your property instead of somebody else's? High socioeconomic score, so obviously there's a lot more affordability, there's higher incomes within that market, naturally comes with those higher socioeconomic areas. But the interesting thing for me is these annual rental volume and annual sales volumes for houses to units. You can see the annual rental volume for units is 1,000, close to 1,200. That's a massive turnover of units within that market. So like I said, if you're buying a property to lease, there's such high turnover with these properties. What's making yours stand out compared to these other investments, and making sure that you're keeping those vacancy rates down? Significantly different for the housing market. There's only 65 rentals for the housing market. But as you can see, the affordability index, both for houses and for units, have compressed significantly. More so for houses, obviously, that becomes it's a higher price point, but significant compression in that affordability. And I think we're going to enter that new growth cycle, and complemented by the supply and demand dynamics at the moment. Yeah, we can see here, I at a high level just like to look at inventory to days on market. You can get a really good understanding of where a market's positioned based on those two factors. But if you are getting a rental property, or an investment property rather, vacancy rates 0.5%. It's an ultra tight market, and that's for both houses and units. They're at the same vacancy rate period. Inventory, there's slightly more stock for houses than there are for units, which is interesting because there's so many more units for that market, but they're both trading within the same time period, 46 days for units, 48 days for houses. I would like to see it less than 30, but it just goes to show that sensitivity in the market with where it's at in its cycle at the moment. I would likely start to see when this market starts to accelerate, that's going to pick up and probably trade around 30 to 25 days. In terms of stock over that long-term time horizon, as you can see, there's a consistent decrease in supply for that market, and vacancy rates have compressed over a very long time period as well. So if we continue to see that compression within that market, it'll just complement that upward or that acceleration for the growth. And as you can see here, search volumes online is starting to increase, both the rental and the sales market. So really good signs for Manly. I would say for me personally, it's a buy. For me as an owner-occupier, I love this market. As an investor, 2.5% yields, although you're going through another growth cycle, I would say there's better markets to put your money, but you're certainly not going to lose money in this market. So that's Manly. Stay tuned for other markets. I'll continue to break down all other suburbs. See you on the next episode.